Recording.
All right.
Uh, well, start start with questions if you got them. I have an agenda. A lot of things I think would be helpful for at least all the realtors and all the agents I work with. What I've observed and
Yeah.
my role, CPA's role, attorney's role. But yeah, do you have anything you wanted to start with?
Well, yeah, if you want to, I know we were kind of chatting before I started the recording, but if you want to kind of introduce who you are, tell us a little about yourself, maybe how you got into the industry, and then what a financial advisor is versus a CPA versus a tax attorney.
That's great. Yeah. So I'm Jake Bawab. I've lived here my whole life. Dad dad became a professor at Old Dominion when I was one or two. Um, so I grew up in Great Bridge. I'm in Little Neck now, and I've been a financial advisor for um, 13 years, if you include 2 years of the internship that I did here with Northwestern, and that's how I got into it. I went to a career fair, and I'm one of the 6% in the United States who found something that they love, they're passionate about, and that provides a good living right off the bat. So, um, most folks have to stumble around before they find, as an example, what y'all do. Um, so, uh, what I do is I work with folks and what I've observed. So let's start with financial advisor, and then I'll go to kind of partnering up with CPAs and attorneys. I've observed that a lot of people are doing a 401k, uh, getting a match, doing a percentage. Maybe they're higher income, putting in the maximum that's allowed for the IRS limits. This year it's 22,500, and getting a match. Oftentimes they started a IRA or a Roth IRA at their bank, and maybe they have some money in their children's names, right? Maybe they have a 529 plan. Maybe they have separate savings accounts for their children. And so my role is to say, here's all this stuff. All of it's phenomenal. Anything that anyone does, right, to me is an indication of a willingness to delay gratification. So I condone that behavior, obviously, but I'm going to take a look at all of it top down and say, well, how do all these things relate to one another? How is helping your children going to college going to bolster your retirement, if that's an objective, and what is retirement, and what are you on track to be able to spend if you wanted to stop working at 62 or 67, maybe all the way up to 72. So my role is to forecast and say, here's what you want, here's what you're doing. You're not doing enough to get to where you want, is kind of how it used to be. But now a lot of folks, especially the younger generation, believe it or not, hey, now you're doing way too much. Let's upgrade that truck and live life a little bit, because you could die before 65, right? So my role is situational awareness, bringing that, and then saying, here's what makes the most sense in relation to your income. Should we, get more tax deductions now? Do you make so much that you're going to pay 47% in Virginia, regardless of buying a work truck and doing tax deductible things and whatever it might be? Um, and that's kind of later is, hey, Roth, traditional, what can I invest in and still have it be liquid and available to me to help me buy commercial real estate, or whatever y'all's individual objectives might be. Um, so that's a financial advisor. A CPA, there's different taxes, right? And everybody knows about income tax because everybody hates income tax. That's where a CPA is really going to help. I believe most people listening to this will be 1099, so you could say self-employed. I couldn't speak to the value of a CPA and any more highly. I would say, well, your primary care physician and your CPA are more important than me. I'm okay with that. Right? So taking advantage of the tax code in a legal, ethical, moral way is something that 1099 folks should consider. But at the end of the day, income tax is something you have to pay. For the folks that are going to see this that are W-2, that's okay. There's still a lot to take advantage of, and guess it's less stressful when you're paying taxes every couple weeks, right? But a CPA is going to help you structure your entity. So a lot of you are going to be you and one other full-time person, and you guys are just getting after it. A lot of other folks are going to have 8 people on their team and 2 lead salespeople, and all of that is phenomenal. But as the owner, let's say I'm speaking to the person who started the enterprise, how can you make all your employees happy, retain all of them, right? Have a simple IRA plan or a 401k plan that's getting a match and do the right thing. And how can you also, as the owner, do other things that are discriminatory, meaning you don't have to offer it to all your employees? And that's where a CPA is going to come in and say, as an example, you have the entity, right, the S corp or the LLC, and we're going to flow that income to you, to your own LLC, and that's where a CPA is going to help you be able to be more autonomous, and then also mileage, make your children employees. There's an Augusta rule saying you can have your personal residence rent the business for 14 days a year, started with the master. So a CPA is very crafty. I'm not a CPA. I don't give tax advice, but financial advisor's role is going to be more in the capital gains tax world and the estate tax world. So how can we avoid future taxation? And we'll get to that. But that was a lot. CPA, income tax, financial advisor, grow wealth, avoid capital gains taxation and estate taxation. And then an attorney is really a whole nother can of worms, but that's just, hey, what if something were to happen and both spouses are in a coma? Big deal. Who's calling the shots? Who has the medical directive if that happens? And if that's not taken care of, right, then a court is going to be assigning duties to people who might not want it or might not be very responsible, but there's just a familial relationship. What if death, disability, etc., were to occur and the kids are 21 years old? If anybody has a 21-year-old boy, that them receiving money at that age is very similar to a 12-year-old receiving money. So there's your trust, right? And then will and power of attorney. So just depending on the situation, that's when someone like me or someone like your CPA would know when it's time to bring in an attorney. So let me stop, catch my oxygen, get some saliva in my mouth again, give me feedback or tell me more questions or where to go from here.
I think that's great. I appreciate kind of walking through all of that, because I think sometimes those lines can get kind of blurred, especially between a CPA and an advisor. So that's super helpful to know, because although you probably are well versed at this point on S corp and this and that, it is helpful to know that you're going to be looking for the future, planning more of that kind of thing than the present time. How can we get X, Y, and Z different tax cuts and this and that, tax breaks. So that's great. So as far as your services then, what do you predominantly, you mentioned real estate agents, small businesses, you mentioned as well. What are some of the maybe 3 pillars that you would recommend someone as they're maybe just starting out into a small business or as into real estate?
Focus on the CPA thing, understanding of income tax, how it works, and be prepared. And some of the more, let's say mature, agents might be able to give advice and explain that it's not that bad. If you make $150,000 in your first year, the tax liability won't be perhaps as bad as you think it might be. So that's a starting point. But the three pillars I would say really for anyone would be short term, midterm, long term, right? And so in the short term, we got cash. In the midterm, we have a ton of options. And the same with the long term. Now, the long term is more retirement accounts, but the real answer to the question is, how can you have your money participating in growth but also maintain liquidity, there's a million options. Well, what about taxes, right? Because in general, if you're not being crafty, if you have your money liquid, yet it's still earning interest, let's say in something safe like bonds, CDs, money market, or I guess younger,
Bitcoin. I'm just kidding.
put all of your money in cryptocurrency. Don't sound like me. Don't sound like me on that. I could lose all my credentials. Yeah.
Just kidding.
Yeah. So so yeah, young people call a money market a high yield savings nowadays. I don't know. That seemed to have started during the NBA finals, which is the only sports I watch. Or at least that's what I observed. How can money grow, and how can you avoid income tax and or capital gains tax? That's really the pivotal point for people to go from 25 to 35, right? When they're Henry's, high earner, not rich yet, and have an understanding of capital gains tax, which for people that are going to be successful, that's a much bigger tax than income tax. Um, but either way, my point is, how can our money grow, not lose to inflation or even outpace inflation? And how can it maintain liquidity? How can we still buy the things we want to buy? Because I understand you guys go in, you're selling this and you're putting something for sale, and you'll ask the person selling it as you're meeting with them for the first time, hey, can I buy it? I want to buy this, triplex or whatever. So I'm very aware of how that works. So that's kind of the short-term, midterm strategy. And if I meet with someone who is more mature and they've done a lot of things and they're thinking about when they're going to retire, let's say mid 40s, and they're very successful, yeah, we're going to start flooding retirement accounts because they don't need to maintain that liquidity. They have enough in the bank, and their drop dead plan would be they could just take a home equity line from all the things that they already have to keep acquiring properties, right? So, yeah, again, savings, a bunch of stuff, retirement accounts would be the three pillars, and having a strategy for all three, really just having situational awareness, right? Like it's as simple as people who step on the scale every day cannot gain weight, according to Stanford, right? So if you look at your bank account every day, it's not going to go down, right? The good effect would be it's going to go up. So it's just that awareness of what's the trajectory, where am I heading, in daily bite-sized chunks, not one big hour when you're feeling creative on a Sunday and you have all this discipline. That just doesn't work, right? So it's just habitual. Yeah.
No, I think that's great. And one of the things that you touched on was, flooding your retirement accounts for a while, and then, pivoting when needed and all of that. I think that that's a huge thing for real estate agents because, although I want to do this until I'm that person that everybody talks crap about, because whatever the new version of, I'll be still sending emails and there'll be like, we're back to using, I don't know, whatever the new version is. So I'll still be like the person using faxes. Even though I want to keep going until that point, the reality is we do need to have some sort of game plan to get out, because we're not in a world where we have an employer who is putting money aside for us, right? We don't have any kind of pension or this or that. So can you talk a little bit about some of the basics or however what we should be planning, because we don't have any kind of matching programs?
Yeah. General rules of thumb. I'm sorry, I have to make it boring. Let's start with taxes. Everything that you could put money into has a pro, everything has a con. If anybody is seeing this in their W-2 and they have a match from their employer, that is obviously number one. If your salary's $75,000 and you get a 5% match, right? Then that's a free 75% of $5,000. Never do math in public. That's going into an account, and that's a big deal, because what I'll show in a second is a real a real mutual fund that's been around a while, going back to 1983 and 40 years of investing 10 grand a year. Forget about inflation. I'll take care of that. But you all don't have them. The majority of people seeing this won't have a match. So then what do we do, right? Because what's income? Because a lot of people can afford to pay the taxes. A lot of people are, well, actually the majority of people seeing this are in that, 250 to 2 million range where taxes are unaffordable. So deductions make more sense, right? And the options really would be in relation to retirement accounts. There's other things that have other pros and other cons, and they also avoid taxes on the front, the back, the middle, wherever. But let's just go traditional Roth and keep it simple. You can put away, right? 75,000 is the salary in this example, or the income earned. You can put away 10%. And in a traditional account, that's a tax deduction. So off the bat, before the standard deduction, children, interest on your house, and then for the majority of you all, mileage, the security system at the house, blah, blah, blah. Off the bat, 75,000, take away 7,500 from the top. So we're starting at 67.5 of income that's taxable. So it's going to help your refund grow. Or let's be honest, 98% of you don't pay your quarterly taxes like good little boys and girls on time or enough. So it'll reduce how much is owed in March, right?
I feel seen.
Yep. I see you all. I know how you feel. I've been, what do we have? Until October 15th. Let's take our time. Worth noting, I have a very similar contract to all of you. And I have my whole life. That's the only downside of it is April 15th. In our case, October 15th. So you reduce your income, and that's a win. And you don't pay tax as it grows. Like liquid investment accounts, you need to pay a 15% capital gains tax on the interest. If it's in a mutual fund, every single year you get a 1099. If it's individual securities, when you sell. The downside of, right, you got two upsides. You reduce your AGI, you didn't pay capital gains tax for 35 years, but when you take that money out, you need to pay income tax. And sarcastically, our tax rate's going to go up or more. And it's worth noting, we're in our third lowest tax brackets ever, regardless of income in U.S. history. And that's locked out until 2025. And we don't really know where it's going to go, but we shall see. So that's a traditional tax deductible IRA, 401k, thrift savings plan to all you veterans. Thank you for your service. 457B, ICMA, right? Tax deductible. And then you have a Roth. And a Roth, and you're making so much money and you're so good with money, you just don't have kids, right? That's all it is. But you have enough free money where you can put away that 7,500, but before you received it, you paid tax on it. So that's a $10,000-ish loss, 11,000, right? More based on income. But you invest that money, there's no advantage to it. Then it grows with no capital gains tax. And when you take it out in retirement, it's tax-free, which is a really big deal. So that's taxes. How are you going to do it? Are you going to do some Roth, some traditional? What's affordable? What makes the most sense? But how much you put away is important as well. And so I just want to say, in all of history, if you give it 20 years, which is what we need to find the trend with the general stock market, if you start at 25, right? Let's just say two people, one's 25, one's 30. You start investing the same amount. When each person is respectively 65, the one who started at 25 will have 2 times as much as the person who started at 30. So how much you put away is just completely different for every single person. And if you're 42 and you're listening to this and you're like, God, I know that, and I still haven't started and whatever, don't stress it. I mean, I have so many people who started at 57, but that's when their business was ready for them to peel out enough. They've lost that rate of return on hiring more people. So there's nothing to really reinvest in. and they can put away a lot of money for 8 years, and retirement is still fully funded. So it just depends on who you are, where you are. But if I'm going to sit down with a 25-year-old new agent, um, I mean, I'm in competition with Tacomas and Challengers, and I know that. But if I can get a 25-year-old to start putting away, $541 every single month, which is the most you can put into a Roth IRA right now, 6,500 a year, that is huge. They're gonna have so much money in the future, but they don't get a car, they don't get to drive it off the lot, they don't get to make a post about it on one of the things. I don't even know what they're called anymore. Their friends don't know about it, but they get 4 pieces of paper every year called a quarterly statement. That's it. So where's the dopamine in that? But there's a lot more dopamine later in life. So yeah, that was very long-winded, but invest more, invest often, start very young is the answer.
No, that's great. And so I think that's really good what you said as well. It's never too late. Because people could be restarting their lives or doing this or that. And so it's good to kind of have that in the background. So as far as tough conversations, what if I tell you I have zero in the bank, I don't have a Roth IRA, I don't have any of those things, but I want to go on 3 cruises every single year in my retirement? Like, what are those conversations? How can you get someone from not being in a place where they're even considering saving to trying to have some sort of, perfect retirement plan?
I have to call my therapist after this because you're bringing me back to my early years. People would show up and say, "Yeah, that's my new car. We're not doing anything here." I say, why'd you come back? Um, I can't care more than you is really at the end of the day. Like, if you're gonna do it, you're gonna do it. That's fine. I was ready to answer until you said, like, it's the mindset, right? It's the mindset. Now I can help you understand how this is a lot more attractive than 3 cruises, right? And how just off of the interest of the cost of 3 cruises, if you just put that money in the stock market at 35, you'd be able to probably go on 36 cruises at 62. I can do all that, but if you don't care, I can't. I can't persuade a made up mind, if that makes sense.
Yeah.
So I think the question was, well, if you forget about the mindset for a second, if it was the same situation, but you're like, but I want to do it, I want to be successful, I want to put money away, I would just ask for, let's say 3 months of bank statements, and let's see where the money's going. Because if you have 0 in the bank, well, usually that means you have 20,000 on the Amex as well. So there's really, we're way behind, and that's okay, because I'm just realizing if a lot of people see this, there's going to be people in that position, and I've been in that position, and I don't think it's that big of a deal. It's easy to course correct and fix. It's just a matter of not desire, not willpower, just setting up habits that lead you in that direction, right? Every morning when you're stretching, meditating, you look at your bank account for a minute. Then direct sunlight exposure, and get your run in and all that stuff, right? But it's easy to go from where you are to the person you want to be, is what I'm trying to say. So if you have the desire, but you don't have the numbers to back it up, let me see bank statements. Because if you want to go on 3 cruises, that's cool. But oftentimes I'll find you're spending $4,800 a month at restaurants and bars. So you can't do the little things and the big things. There's got to be some sacrifice. Even Bezos needs to sacrifice something at some point. Like, there's a limited number. That's a bad example. He doesn't have a limit, but almost everyone has some sort of limit as to how much, right? And you got to prioritize and execute. And so let me see the statements. Let me see what you're spending money on. And then the answer would be forced savings. You have 0 in the bank, but there's no liabilities. There's no credit card debt. And you're renting, so there's no risk of the HVACs and roofs and all that stuff. Okay, I'm gonna take 2,000 every month. I'm just gonna put it in a money market. I'm just gonna take it. And that sounds scary. Okay, I'm gonna take 500 every Friday. And from there on out, people don't miss their bills, especially someone with nothing in the bank and no debt. The bills are getting paid. Let's just add a bill that builds up that balance sheet. And then 4 months down the road, we'll have our first review meeting. And then I'll up it to 2,500 because they've gotten used to it a little bit. So let's increase that weight so we can break down that muscle, right? And now I'm going to start peeling out 541 to a Roth IRA. And then I'm going to start peeling out, 1,000 of that for that 2,500 and put it in a brokerage account, a liquid investment account that's earning interest and could also retract once a decade when the stock market goes down, but it's going to grow by a heck of a lot more than a money market over the course of 10 plus years. And then 8 months from inception, we're meeting again, we're expanding. And so it's easy to go from here to there. Even for myself, it's just a matter of the power of the ACH. And then usually when more comes in than is needed, I'm going to take it now, dump it into my brokerage account. Because if I don't do that, I'm going to spend it. So on that day it comes in, we're doing the financials, cool. We got an extra $3,000. It's going in the brokerage account. So now if I want to spend it, I got to wait 3 to 5 days to sell shares, raise the cash, take it out. Right. So that's limiting. I'm not going to buy that thing at Home Depot. I'm in my mid 30s now. So it's gone from fun stuff to lawn stuff.
Yeah, that one hit home easy on Home Depot. Okay.
I think you meant Lowe's, but that's okay.
No,
kidding.
Home Depot gives a better military discount. So.
Oh, well, I wouldn't. Fortunately, I don't qualify for that one. So I don't run. So that's my my limitation there. So I think that's really good. So you're really hands-on, it sounds like, with what you do. You're actually diving into the statements and I think that it sounds like you're customizing per person, per client, what you expect from them and what you're able to kind of slowly ease them into versus, the financial peace university mindset of, okay, cut up all your credit cards, don't touch another one of these, put all your money into envelopes, that whole, some of the things that you hear about, I can say that, you don't have to say that. But,
yeah, there's no general advice. Everyone's different and you get to, that's why I'm just absolutely hooked on what I do is everybody's so different. They have a different story. It's all about personality, right? There's income, expenses, whatever. That's the subjective material. But yeah, a good advisor, right? Like there's a certain limited amount of people that, like me as an example, I work with, I can spit off in a moment's notice what's ish in their 401k and their bank account, what they're scared of, what their priorities are, what we're going to do when we get together next meeting and kind of guess within a couple of weeks of when that is. So that is the value in an advisor is you have a coach essentially. And ideally, as you're doing research, if this is intriguing anyone and doing research on who they want to work with and asking friends and stuff, that person ideally is leading by example. And ideally their financials are on the table too, right? I mean, that's always been my approach is to be an open book and lead by example. But just like you all, the top 10% who are 90% of the revenue, they're leading me by example, right? They're where I want to be and I learn from them and then I run it to the majority of you all and just kind of share, hey, here's what worked for some people that I think have similar mannerisms to you. And they're quite wealthy, and even the quite wealthy that I know about that they have with me, like they have other money all over the place. That's somebody who you can emulate, and I can just share, of course, with a lot of anonymity, and every discussion is highly confidential from a legal perspective. But you get the point. Yeah, I didn't mean to cut you off. I'm so sorry.
No, I think that's really good. I think that there is always, anytime you're talking about financials, there's always a level of embarrassment that can be there. And especially within, obviously Hampton Roads isn't like selling Sunset, but people do have expectations of real estate agents. You know, they're supposed to own their own home, you would expect, and they're supposed to dress a certain way or drive a certain kind of car. And I think that that's not necessarily the mindset anymore. I think that the industry is kind of pulling away from that a little bit, but you know, I think that having someone that's in our corner to kind of coach us and help us along our own journeys, because we're all human, we're all going through our own personal things. And so I think that is really good to know. I recognize we've talked for about 30 minutes on questions, which I'll make sure we don't have any other questions, but I also want to recognize that you have a presentation, is that right? As well, or?
I can. I don't have to.
Okay.
I'll show you one thing if it's okay, because
Yeah, absolutely.
it's attractive. So Jed, I couldn't remember what you said, so I saved it as persistently late agents, and I have notoriously late agents. I don't know. Just
Yeah, persistently, yeah.
hope you're pleased. Yeah. All right. So I just ran. Okay, this is with Capital Group. They're the third largest money manager in the U.S. Their corporate home office is right out off of London Bridge. Buy local, baby, right? And you've never heard of them, and they've been around since 1827, right? American funds. You have heard of them, but somewhat. Either way, very reputable company. I'm just running this because I use their platform. I have no ties to this. I have no ties to them at all. But for a newer investor, I like to sell American funds. It's low fees. Again, they've been around for, I mean, this fund has been around since 1970 something, 1971 or 1974. But no matter what you get with Fidelity, Schwab, T. Rowe Price, it's all doing essentially the same thing, especially nowadays. It's all the same algorithm, the same rebalancing, the same securities, right? This is still 4% Amazon, just like everyone else. So I don't think this is special because it looks very attractive, right? So really what we're looking at is putting in 10,000 a year from 1983 until today. And here's what the valuation would be on New Year's Eve every single year. So if we take a look, we have the dot-com bubble right here. Things were kind of ending with a rally, but then in September of 2001, something happened. And airlines were a really large part of the economy at that juncture. So it's worth noting that much larger as a percentage than today. But either way, the whole dot-com bubble continued. Here's the end of 2002. And then we have a recovery period. And then we have The Big Short with Steve Carell and Brad Pitt. Don't forget about Brad Pitt. So we have the housing crisis, right? And you can see here we get down, from 1.7 to 1. And it's worth noting that the kind of lowest point in this valley was March 6th of 2009. So we continued to go down. And then all of this recovery was, 99% of it was 3 days of trading from March 7th of 09 to the end of 09. And I don't know the dates off the top of my head, but it's worth noting when things are falling apart, stay where you are. Don't sell your shares. It's too late, right? And when things are skyrocketing, don't put it all in one entry point, right? Because when things are already up, it's too late, right? It's just kind of general rules of thumb. So we got 1.4 here, and then we have a wonderful bull market similar to the 1980s. And then in November of 2021, my phone started ringing all the time, and we started going backwards, right? And then what's really convenient about the down market that we are still currently in, because we're not back to where we were, as you can clearly see. The convenience is the lowest point in that was the last day of trading last year, so December 30th. So you're looking at it right there. There it is. And then here's where we are today. The majority of that was January and June. And if we were to have a real timestamp on August 24th, you would probably be seeing 7.35, 7.4 million. It's been a crappy month. That's part of the process of whatever recovery that we're in, or it's just part of the process in the general stock market. So my point in all of that is let's extrapolate and push it forward. So today it's 1983 and Jed is today, 2003, you start, Jed, you look 25, so you're 25, right? So hypothetically, I'll tell you, if the stock market gets similar performance to what happened over the last 40, the next 40, if you put that away, never increase it, so that 833 every month just gets easier and easier and easier and easier, outside of hard work and real raises above inflation. You put away 400,000, you have 7.6 million. In today's dollars, I'll be very conservative here and say that's about $2 million. Realistically, it's like 2.8, 2.7, but let's make inflation 1.08% more than any 20-year period, which it's always 2.92, by the way. And I know what we're coming out of. That's part of the process. 11%, 1% for 9 years. Either way, if you had $2 million in today's dollars, you have 2 million today. You put away 400,000 present to past value, so that feels like in today's dollars an average of about 200,000 with inflation. But either way, you put away 400,000 in today's dollars, you have 2 million, what feels like 2 million. Now you're 65. You're 65, Jed. You're going to be more conservative. You're going to be living on this money. So we can't keep that 11.61% return because we can't afford the dot-com bubble 0809 where we are right now. So we're going to go in a 60% stocks, 40% bonds mix. I can very comfortably say your average yield is going to be 8% instead of 11.61. So you get an 8%.
But more stable.
What's that?
But more stable.
Correct. Yeah. But more boring. Come on, Jed. You need to buy a boat, so I don't have to buy a boat. So if you're getting 8%, inflation's 2.92, but let's make it 3.5. I like to run this conservatively. So inflation's 3.5, and Jed says, "Hey man, I want to leave all my money, 2 million in today's dollars. I want to leave that to my kids, no matter how old I live, and I want it to track inflation." Well, what that means is we can take out an average of 4.5% per year of the total nut. So if you're getting 8%, we need 3.5%. Jed takes out 90,000 a year. So Jed takes out 90,000. The whole thing grows at 3.5%. Next year, Jed takes out 92,750. So Jed's paycheck is going to track inflation, and he's preserving that legacy. That's the general rule of thumb. Less kids is less legacy. You spend more. Less expenses, right? Jed retires, his house is paid off, right? That's more than you can spend. That's called the rule of 4.5. That's your Financial Peace University of distributions. It's very that is very custom tailored, and where an advisor really earns their paycheck, because my analogy is hiking down the mountain after your muscles have cooled off, you've been drinking cold water, taking selfies. That's where people get hurt. So that's something we're usually doing every January. What are the expenses? What are the distributions? Fill up the savings account. They have a year in the bank. But yeah, you put away 10,000 a year, you can spend 90,000 a year. Present, that same, forget about inflation. So if you start at 25, you'll be able to burn 9x. And that's as conservative as possible. If you want to leave a wonderful legacy to children and grandchildren, you can spend more. That's not a priority. Was that fun? Does that make sense?
Everything except for me being 25. I'll be dead in 40 years, but
I think he was saying he was
appreciate it.
25 in 1983 when that chart started.
Right.
I'm just kidding.
Yeah.
He was one of those young men that bald and turned gray real young. That's all. Like, it was a compliment. Yeah.
No bald, but definitely gray.
No. So something then, all of that's super helpful. Two other things that I want to touch on. One is HELOCs, just because that is something within our industry that I think people throw the word around, but we don't talk about or fully understand. So if you can speak on HELOCs. And then second is reverse mortgages, if you're able to speak on that. And And maybe you're not, I'm not sure about that piece, but if you could speak on that as well, since that's something that our clients sometimes ask us about.
Yeah, for sure. Let me remove my professional hat and just say, with a HELOC, I got the house for the school system. Wish I didn't have it. Can't wait to downsize and have 1,000 square feet, no lawn. But because I have 3 kids, I wouldn't touch a HELOC because that just introduces risk. Like, what if, what if, what if? And now, like, where are we going to live? I don't have a smorgasbord of rental properties. So a HELOC, I think, is a pretty clever way. You know, if you have 3 rental properties and each one has 100,000 of equity, and you need 120,000 to put as a down payment to get a 4th one, you may as well do a HELOC and do it and keep your 200 grand in the bank, keep your retirement accounts and all those other things. Keep them safe and put away. Reverse mortgage, I don't like, but again, my lens is 3 kids. I want to leave them gazillions of dollars and raise them right so they appreciate it and start that process long before I'm dead and help them with their first 20% and pay for their college. And I know a lot of people disagree with that. That's okay, right? But what do you want to do with your kids? How do you want to help them, right? So I don't like a reverse mortgage because, I mean, currently I'm the product of my wife's grandmother passes away, and the legacy to the 5 kids is the house. And that amount of money for a house in Orange County is a big deal to all 5 of the siblings. You know, and when you factor in a reverse mortgage, then it's just less legacy. So I don't know much about reverse mortgages. And a home equity line I see is using other rentals to acquire more rentals, assuming that the one you're getting right now is a 15-year mortgage and you got at least 15 more years of work, right? Because in my opinion, this whole cash flow thing isn't happening. And, you know, if you're not putting 50% down off the bat, or if the property isn't paid off. And again, I don't know much about it. I just work with a lot of realtors and a lot of agents. I hear a lot about it. So the answer I would give you is, if you have investments like this, well, first off, there's less of a probability that you would feel the need for a reverse mortgage, and there's more options when it comes to whatever the reason is you may be doing the HELOC. And so what I mean by that is, I like to tell everybody, this stuff that I do is not in any sort of competition with what you want to do with rental properties. And what I mean by that is, all the money you would have with someone like me outside of retirement accounts, right? Your brokerage accounts, cash value and life insurance policies, blah, 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 all the things. You can structure a securities-backed loan, which is very similar to a home equity line, and you can borrow money against your asset. And if done right, you can have your asset earning, I'm not going to share my screen again, but 11.61% on average. And a lot of times you can get a fixed rate securities-backed loan in 2021 at 3.5% or at 2.85% was, you know, some things we did personally in the backyard, involving my kids being in water and going to bed earlier because they're more tired. But there's a lot of options. And so I like to tell everybody, hey, if this is your objective at 30, you want to get, you know, these Grant Cardone prop, you know, brother, I don't like flying private. I love flying private, right? If you want to get all these properties, all these units, if you have things like this, you can utilize them, buy the property, and still have an asset. And yeah, there's a liability on the line and there's inflation, but 11.61 minus 2.92 inflation minus 7% interest rates right now, you're still earning a positive 1% on that transaction, and you got the thing that cash flows. So there's that, but then there's home equity lines. There's the answer to your question is, what's the situation? What assets are available? What are the liabilities in the books? What's the debt to income? What kind of loan can you follow? What can you finance? Right? There's so many factors. Oh, you have 6 properties, even though you make $3 million. The bank says you can't get another loan for another rental, which happens all the time with people I work with. It's like, why? How does that make sense, right? So the landscape is different for everyone. Yeah, there is no answer. Sorry about that.
No, that's okay, because I think that what you touched on is it is going to be different. And I think another thing that it sounds like you're saying as well, though you didn't actually specifically say it, is what is your risk tolerance? Because it
Yes.
sounds like you personally, your risk tolerance might be pretty low because you're trying to plan for your big thing is legacies, and then someone else that maybe I'm going to leave my money to my dogs. Maybe my risk tolerance is a little bit higher. So I think that is that's helpful. And I think that obviously we are never going to speak to our clients about all of the pros and cons of a HELOC or this or that, because we're not a financial advisor and we don't know what their specifics are. We can tell them, hey, here's what it is, but you're going to need to talk to a professional. And it's good to know that we can then direct them to people like yourself to really navigate through the specifics.
Loan officer. I believe I heard loan officers. Yeah, loan officer. I mean, I can give general advice about anything, but
True.
I
Yes.
can't give professional advice about that, taxes, law stuff, anything cannabis or crypto related. That's about it. Yeah.
Okay, so yeah, okay, that makes sense then. So we'll direct them to a loan officer because they are the ones that actually do it. I didn't know if you are comfortable speaking with them about repercussions of, but at the same time, I understand that you always have to stay in your lane with certain things and all of that. So that's good to know. Because I definitely would have said, speak to your financial advisor. So now I'll know, speak to your loan officer.
Well, no, the client will get the information and the parameters of the loan and how much they can get and what the repayment amount would look like from the loan officer. And then someone like me, if I'm doing a good job, I'm kind of at the head of the table of advisors. If I've done a really good job, I'm wearing shorts and flip flops, right? Because we got a great relationship, and that's where it's like, hey, that makes so much more sense than burning savings if you want to buy that RV or get that rental house, whatever it might be, right? Like, what's the best thing mathematically, based on, yes, risk tolerance, absolutely. What's their line of work? Are they selling something, or are they a high ranking naval officer? Because there's what's the probability of income staying the same, right? Things like that. Yeah.
That's perfect. Yeah.
I've got a question. This is just rather specific to me, but all right. So, and I need to set up a meeting with you anyway, which we will do, but I would like to touch on it just quickly. I was part of EXP for a while, and they do the whole profit sharing stuff.
Oh, now we got to edit this video when we put it on YouTube.
No, as I left them, it's cool. So
I'm just kidding.
Yeah. Well, yeah, don't join EXP, and this is why. All right, so basically, every time you sell a house, they're like, oh, well, here's some discounted stock, right? So now I've got all these 200 shares or something of EXP stock, and the shit's all over the place. So, and I've been trying to figure out what to do with it because it's quite a bit of money in stocks, but it's all in one stock, and EXP is not a stable one by any means. I mean, it's real estate. It's a real estate company, the prediction, the projections for it look great, but stock projections are, I'm sure they're not even 50% accurate probably, but so yeah, I've got like 200 shares of this stock, and I need to figure out what to do with it, and I can't afford to be risky with it, but what do I do with that?
Well, as I see what that amount of money is, I would say if you have 20 times that amount in other things, then you're not taking that much risk. But like in general, it is really high right now. Right now you're incurring as much risk as you possibly can by having it in one company.
Yeah.
And there's nothing wrong with that. Like if you were early on at Amazon in 2000 and you were like, no way, man, this guy's visionary and the leadership bench is legit, and they're a company that's going to be great, not good, meaning they're going to do 15x the index they're in for more than 15 years, then keep it. But based on how you feel about it and based on the zero research I've done about it, you could take that money and split it up amongst the 5 1,000 largest companies in the United States in a mutual fund and get 11.61% over the next 40 years, which is enough, right? Regardless of who you are, it's enough. I don't really like swinging for the fences.
Right.
I'm willing to take risk. I just prefer not to bungee jump with my portfolio, right?
Yeah, and that's what I've been seeing. So when I think I started in like 2021 or something with it, and it started very high, and then it got down to like 50% loss, and it's just now recovered back to, close to where I had gotten it, but then it dropped another $1,000, and I'm like, I don't like this ride. I kind of want to get off, if you know what I mean. So
Yeah. So if it's not, the thing is, if it's in a profit sharing plan, can you, and this is, if it was just you and I talking, I'd be like, yeah, send me a statement, me and my team will look at it and we'll let you know. But if it's like RSUs, reserve stock units, and you can only take out a third every year, right?
yeah,
Things like that.
profit sharing wasn't the right term, actually. I actually have the stock, and it's in an E-Trade account. So, I mean, I know I can do stuff with it. I just don't know what to do with it. So,
Mhm.
yeah, that's something, but that is something like I could bring to you, and you could say, all right, well, let's do this with it. Sweet.
6,500 in a Roth, backdoor Roth. If you make too much money, we can do that. Well, maybe not. If you have an old traditional IRA with balance, we can't do the backdoor function, so we can do this or that, or yeah, it's tailored to you. How many kids
Okay.
do you have? Your income? What are your expenses? What's left in the mortgage? Blah blah blah. So it's really fact finding, seeking to understand what you're trying to do. What you got can be an email, but hey, what you got? What are you trying to do? What are the next 1 year, 10 years, 20 years look like? And then
Mm.
and then it's really, here's what I would do if I were you, based on the 15,000 meetings I've had, humbly admitting I'm the dumbest tool in the light bulb shed. But
It's not good advertising. You didn't say that.
but having experience and knowing people that I would trade balance sheets with, being clients. Yeah.
Perfect.
Also, so when like I said, I will set up a meeting with you because I do need to figure out what to do with this stuff. But all right, so also I have an 18-year-old daughter who, I've been teaching about savings and stuff like that. So, like, like with her, I mean, like, I think in 18, like, this would be a good like time for her to start thinking about this stuff. I mean, like you said, I mean, hell, you start at 25 and, put away the bare minimum and you'll be set when you're, 60. So, um, I guess, yeah, I mean, of course, I'll just bring her along, but, like, we kind of already, I guess, we already kind of covered what, like, you should do is like, as like a teenager or even a 20-year-old, just start with the bare minimum and just do it and get in the habit of doing it. I guess that's really what it is, just get in the habit, right?
Jed, I gotta tell you, my three best clients that are my age, I inherited when the guy who taught me everything moved to Florida, because they're similar in age. He knew he would drive well. My three best clients are mid 30s like me. They all started with $50 a month, or one of them $78 a month going into something when they were 18, and their parents
Mhm.
brought them in, and they signed paperwork and started one little thing,
Awesome.
And at this juncture, they could let interest accrue and not inherently need to put more away. And our arguments are about investing less and spending more, because
Wow.
there's really no reason to invest. If they keep putting away a third of their income, they'll have 93% as much as they would have otherwise, or they'll have 7% more if they keep putting away a third of their income, or they could just retire at 63, not 62, and have even more than that number anyway. So does that make sense?
Yeah.
There's
Yeah.
there's
No,
a
it
lot of,
does.
there's a lot of value in that. You don't need to worry about how it works. It's different for everyone, but sparks fly, things connect. They
Yeah.
get to see interest accrue, and it's a really good time too, because we're in a down market. You're not guaranteed at all everything can fall apart, whatever, but you're pretty much guaranteed that things are going to go up and there will be dopaminergic response that she will have with investing, and that's massive.
Yeah.
So I
So
think I
basically
want to
start at
end.
18 and you're done at 30 is what I heard.
I
35,
want to go ahead and
35.
I want to wrap up. We only have 4 minutes left. So with our last little bit of time here, Jake, we've heard about all the things that you can do, and all very impressed with you. How do we set up a meeting? What do your services look like? And thank you. I just see you put your phone number in here as well, so we'll be sharing that. So what does that process look like? Do we meet with you? Do you have different levels where we meet with you once a year, once a quarter? What does all your services look like?
Yep, totally depends. Starts with what I described to Jed, Q&A, what's going on, where are you trying to head, where you're trying to go. And then from there, some people, I don't see any reason we should meet in the next year professionally. Hit me up when you're back in town and we'll hang out over Christmas maybe. But other people, they're selling the business or doing something big, whatever. We're talking every week, couple weeks, sometimes every couple days for a short stint. So the process itself, if somebody were to become a client, I always set a review meeting. So for everyone who's an active client, we have a review meeting set sometime in the next 11.99 months. If that answers the question, but the necessity to get back together and look at things is really in the C-suite, kind of like VP world, bonus time, RSUs become available time. For you all, it's end of summer, let's call it. You got big fat pockets and you're starting to worry about taxes and all that kind of stuff. So it just depends. Sorry, that was so long-winded.
No, that's good. So what does it look like for frequency then? Do you, and I don't want you to say a rate. I want to be very clear. I'm not asking for a rate because this is a recording and in theory, your prices may go up. So what does the system look like though? Are you a flat fee, yearly flat fee? Are you a percentage fee? Are you a frequency, hourly? What does that look like?
$6. Kidding. I don't charge.
Verbal contract is binding. I'm just kidding.
Yeah. Wait, isn't minimum wage higher now? No. I don't charge a fee. That was a business model I emulated starting when I first started. I said, I don't want to start with the necessity of a fee. I will if there's a reason and I bring in a lot of work and my team and I need to spend 87 hours doing something. Yeah, sure. Because then there's a risk that we'll do all the work and you'll take it to your fraternity brother or sorority sister and give it to them. So, but I don't charge a fee. I make money based on the money that someone like you would have with me, right? So there's a flat asset-based fee, which, by the way, that's situational as well, right? Less maintenance, less fees, and there's discounts and increases and all that, but everything is discussed, everything is signed off on. But the let me explain first, real quick. The value proposition is if somebody works with an advisor, has a good relationship, said advisor can get them to invest more than they would have otherwise, get them to stay put when the stock market goes down, and get them to not put all their money in Ethereum and Bitcoin in 2020 and 2021. They have that pull on them. The average rate of return on all their money is 3% higher per year, which is a bigger deal the younger they are. And that's a Morningstar study. They don't sell anything. All they do is rate companies, mutual funds, whatever. So you get a 3% higher yield per year. And on average, the fees of working with someone like me is around 1% per year of the assets that you have with someone like me. And that's very similar to a bank, at a wirehouse, or someone like me who cut in the insurance world. But does that make sense? It's very similar to
percentage. That's great. Yes.
You basically charge a commission like we do.
Yeah, you're converting FSBOs. You're going to make this much more if you use me. We're used to that language.
Yep. Which, by the way, the average 401k in the United States is, I think, 1.85% right now. Justifiably so. Employer, employee, payroll, HR, all these things, right? Cheaper than a 401k, right? But hey, the more you put away and the more you have, the more I get paid, and the less you pay as a percentage. But I still always win. if you're cool. If you're a lot of work, then I don't. But yeah.
Excellent. Well, thank you again so much for joining us today. This was very helpful. I'm excited to give you a call soon. Actually, I'm not excited because you're going to grill me, but
No
but
judgment. No nice things as well.
all right. Well, thank you so much. We'll be sharing your phone number with our office as well. If you see it in the chat, go ahead and write it down, everybody that's in the room. But other than that, have a wonderful rest of your day.
Thank you all. Hey, call me if you call me if we meet. Nothing is committal. There's no binding. Just call me. I think I might be able to help. If not, I can get you to the right person. I'm here to help. I'm here to serve. So thank you for your time, all of you.
Thank you.
Thank you.
Absolutely. Take care. Bye.
Bye.